Hey, good morning, everyone. Marty Missouri here. It's Tuesday, the 22nd of July, 2025. Today is going to be my only video commentary this week. We have a family camping trip scheduled for late this week and through the weekend, so I don't believe I'll be able to reach out with the usual end of week video this week. So for this morning, we're not going to get really into any news headlines unless something comes to mind as I go. On several videos of late, I've been showing you the daily breadth readings, and it was on days where the market generally is doing good, but most stocks were down and so on. So I wanted to show you how that's been evolving on our longer term breadth charts. This is something we update every week in our overall kind of macro scoring of conditions and so forth. And then we'll take a look at the charts that look the same. I'll warn you ahead of time. And they're not great looking charts on the dailies for the stock market, a couple major indices, and then yields and gold and the dollar. So starting with breadth, the graph in front of you is the S&P 500, very simple here, the line chart on top, and the S&P 500 cumulative advanced decline line below. So this measures the number of advancers versus decliners on a daily basis. And when it's going down, obviously, there are more decliners than there are advancers, and vice versa when it's going up. So here I have us back just the last, 3 years, back to 2022. And you can kind of see how this evolves. Here we have the market inching up a little higher, and we have breadth via the AD line flattening out. And in 2023, that was a double-digit correction, I believe it was, here later in the year. We had both rising out of that, began to top out in terms of breadth right in here. And then in 2024, had probably a high single-digit, maybe a 10% correction right in there. And then we had this rising wedge pattern, very notable bearish divergence on the AD line before we saw a 20% drop earlier this year. And then you can see kind of working our way out of it, pretty good breadth just until recently. And this is kind of that daily picture I've been showing you, showing up over the course of the last few days as the market has come back into all-time high territory. Now, when we look at the S&P versus the number of its members that are trading above its 50-day moving average, it is trading above its 50-day moving average with a pretty wide margin, about 4%, and that's an unusually wide margin. And I want you to notice how much the S&P lives on this line. This is about a 5.5-year chart, just takes us right before COVID. And you can see it's just very frequent visiting the green line, the S&P 500. So when we get above it with a pretty wide margin, and we expect that normal action where it comes down and tests it, kind of a reversion, if you will, back to that level, we start thinking about, it could be a correction in the offing that is something people will notice. And sure, a 4% short-term correction is something people will notice. Now also notice that we do have our rising wedge pattern. We have a higher high in here, but we have a breakdown in terms of the number of companies that are trading above their 50-day moving average. We have the market way above it, but only 63% of the components are actually there. So that's a very not good measure of breadth, if I can say it that way. And you can see this has been a great indicator for us, actually in both directions, frankly. Here we see it bottoming out as the market was still plummeting during COVID. Here we see it giving us a positive divergence when we kind of had a pretty straight line here between these two bottoms. Very negative divergence before the 27% decline in 2022. But you noticed we started getting a signal that we're coming out of it right in here. And remember, we acted on that back in the day. And then right here, you see a lower low, but you see the breadth getting better. But here you see it getting worse, single-digit correction. Getting worse. So we had some, some of those 3, 4, 5% dips in here, a bigger one right there in 2024. And then the 20% dip this year again with massive bearish divergence. And we're kind of getting that now. I could draw a down line right there. So the breadth, looking at the number of companies trading above their 50-day moving average versus an index itself that's in all-time high territory, and 4% above its 50-day moving average, that says, be braced for something not so good in the potentially near future. 200-day moving average, we have the market 7%, call it 6.7% above its 200-day moving average. That's a pretty good gap, but you can see it does tend to trade higher above this one. But we have only 60% of stocks trading above their 200-day moving average. Very, very negative divergence. And to put that into context, right here we were up here during the last high with about 78%, even still with a bearish divergence, and then we got that big drop this year. Again, works the same way, slower moving, takes a little longer to play out. Not a good look from a breadth perspective. NASDAQ comp 80 line is the worst breadth chart I've ever seen, frankly. And here's why this one is concerning, because this is how it looked right before the tech bubble burst when it went down 80%, right? Here's what it looked like right before the real estate bubble burst, where it went down 56%. And then all the other times, that we had pretty decent double-digit corrections, it was preceded by a breakdown in the advanced decline line. This is the likes we haven't seen since the tech bubble bursting. I'm not suggesting, in fact, I don't expect an 80% decline in the NASDAQ, but I am concerned that folks are out over their skis with this index and are very unaware of the potential when you see such abysmal breadth. That just means that this is so concentrated. Now, the troops could catch up to the leaders here, and this could resolve to the upside. As you can see here, historically, you don't want to put all your eggs in that basket. Okay, then this is more relative strength, I guess, than breadth. This is the S&P 500, and this is the Russell 2000 small cap stocks, and this is the S&P Transportation Index. After the 2022, correction, we'll call it, the market has done very, very nicely. Notice that small caps have gone nowhere in the last 5 years. In fact, they've gone down over the last 5 years if you look at here to here. And transportation stocks have gone nowhere. So small caps, transportation stocks, presumably very economically sensitive. So this gets considered by some, a representative of strength in the economy, discounted in the markets, so to speak. So again, this is concerning when you look at how it plays out historically, right? Right before a 57% decline, right before a 50% decline, you can see how these things were shaking out. Long negative divergence when you get new highs here. You can't seem to scrape your way there in small caps and transportation. Historically, that's a warning sign. Now, granted, much more tech-driven market these days. Maybe these indicators don't mean what they used to. I'm certainly open to that possibility. And I am open to the possibility that small caps could catch up. In fact, over the last year, we've reintroduced small caps and then added to them lately. They're definitely a part of our core allocation to equities so that we have, exposure to that potential upside, but we're still doing all the other things to mitigate as much as we can of the potential downside here as well. Okay, and then lastly, in these charts I don't usually show you, I created this a long time ago, and in fact I have it going all the way back to the Great Depression, believe it or not, but this is a 50-year chart. Top panel is the S&P 500. Bottom panel is the daily change, the rate of change per day to 1 and 2% bands around the daily move. And then just wanted to kind of track that historically and just to see, is there anything meaningful when these things begin to move meaningfully? When everything is vibrating in a big way, are the rivets going to burst? If you go back to the 80s when we had some weakness, we had a couple back-to-back recessions, you can see in the early stages of that, we started hitting that 2% band and even exceeding it some on both the up and the downside. And we saw respective 16 and 27% declines in the market. We got a little bit volatile right in here. 15% decline in the market. The 1987 crash, which was massive, that's that one day. You can see how far it went down, 20% in one day. Going up, over 10%. But notice, even though that was such a huge surprise, look at what was going on in here. Leading up to that big market crash, we were seeing a heightened volatility leading into it. Here in the early 90s recession, a lot of volatility, not a massive bear market, but a lot of volatility. And yeah, people lost money there. And then leading up to the tech bubble bursting, here we had volatility really ramping up in both directions. And here was that 20% correction in 1998. Volatility continued to be high, very high, as the market continued to mount its way higher. And then finally it broke. And again, 50% for the S&P, 80% for the NASDAQ. But there was a lot of vibrations. I would say, the market shook some rivets loose with all of this volatility. And then here we are heading into the peak in 2007. You can see the volatility picking up, starting to really concentrate. And suddenly there's no space in here. It's very dense in that movement up to and down to 1%. And then these spikes above. 57% decline in the market, European debt crisis. And you can see here, I just measured the moves. So while it was volatile, and here we saw 10, 20, and 11% corrections. 2015 and 16 period, we saw 16% correction in stocks during a lot of volatility. So it's not always horrific or anything to lose a lot of sleep over, but it's just a warning that volatility is high, and this is where we tend to see double-digit corrections. Leading into COVID, we had 10 and 20% corrections, both in 2018. You can see the volatility kind of leading into that. And right in here, this one we didn't have a big warning sign coming into 2022. It just all happened during the decline, but we started really getting volatile here lately. Massive moves. Again, these are the kinds of things you don't see very often, right? And when you do, they tend to occur around pretty big disruptions in the market when you get this kind of movement up and down in the market. So something to be aware of, something that we look at, every week and just kind of think about and apply it at least to our shorter term thesis. And then the S&P 500, struggling a little bit today. It's down, just marginally down, 15 basis points, not much to report. The Dow is flat. The NASDAQ is actually down 0.5%, so the NASDAQ is suffering pretty good today. Our core allocation is actually having a relatively good day. We're actually up 36 basis points, and that's simply because a couple of metals miners that we just added, not big positions. We added half of our intended position, and so we're looking for an opportunity to take our full position, but man, they've really been ramping up the last few days. Vietnamese stocks are up a bunch. Gold continues to defy my short-term logic, as we'll look at here in a second. Gold's up, miners are up, but most of our positions are actually up. So this is a situation where the market's down, but it's very, very concentrated in U.S. tech stocks. Europe's down a little bit as well. In terms of the charts, there is, by my way or our way of looking at the technicals, others would argue, we're in all-time high territory. We're breaking out to the upside. Look out above. I've heard 2 or 3 people, make that case, and I appreciate it. It's not what it looks like to us, but very open to that possibility. We have a market that is consolidating, some pretty amazing gains with some very bearish momentum divergences here. And I've shown you for years and years and years how they don't always play out, but often they do, right before that 27% decline and all the other ones that we've looked at historically. Essentially the same chart for the NASDAQ 100. I'm not taking the time to show you the longer term charts, but they are concerning as well. And even on the MACD this morning, the NASDAQ now has a sell signal up here. That's where the white line drops below the red. But aside from that, breaking down below the wedge pattern, bearish divergences, this looks like it's ready to go anytime now. Now, having said all that, where are we? We're in the beginning of earnings season, and we have tech earnings coming up. So this could just completely blow out to the upside. We've seen that happen, and we've seen it happen during earnings season. It's just that right now, the technicals are saying look for perhaps disappointing earnings or disappointing forward outlooks, and that odds are favoring something lower. Good news on the trade front. Anything could happen to make this not happen. Remember, we're just looking at patterns and probabilities based on history and how this reflects investor attitudes and caution and so forth, among all the other multiple indicators we look at. But these have been worth paying attention to and charting regularly. So the dollar is coming off the boil here. We had a really nice rally. It lost it right at its 50-day moving average. Yields have dropped notably for the last 5 days in a row. They're dropping today as well. You would say, why would that be? And when I see something like this, it typically means to me that it's a reflection of the data that is coming in. I know the leading economic indicators yesterday were disappointing. Here is the U.S. Economic Surprise Index. You can see it was actually going up. It looked good this weekend. Actually, it increased a point in our overall index, but then it's been rolling over this week. What this means is that the data are coming out worse than what economists had expected. Let me layer on the 10-year Treasury yield, which we just looked at, and you can see how, at least lately, just real close correlation. So when the economy begins to suffer, the yields begin to come down. And that's what's happening here on a real short-term basis, it looks like. It doesn't always work that way. There are other factors, supply and demand for treasuries, fear of inflation, so forth. So here you see the Economic Surprise Index coming down off of exceedingly high levels, I should say, while bond yields were rising consistent with that, optimism or that good data that was coming out. But then finally you can see it rolled over with the data. So it moves pretty good with that. So I would say that this is about economic prospects or fear that the economy is beginning to slow. Now, this also, if it continues, is going to make the case for the Fed to begin cutting interest rates. This doesn't make the case for it, nor does this at this point. So I'll be shocked if they cut interest rates next week when they meet. The futures market is not discounting anything, and they tend not to want to disappoint the markets. There are some people on the board, for whatever reasons, who are starting to say we need to. My base case is that they will need to, probably in September, or they will want to. But that remains to be seen. If this big, beautiful bill really gives enough oomph into the economy, or it gets animal spirits going enough, and we get some reasonable, decisions on trade where these tariffs aren't too high, animal spirits could keep this economy going, and maybe they wouldn't be. MRB Partners, Macro Research Board, they are a premium provider to us of economic data and analysis, and they don't think the Fed will be cutting aggressively later this year. They're actually pretty bullish on the economy. Another one, BCA, is another one who we rely heavily on their research as well as our own. They think odds of recession are too high for comfort right here. So lots of disagreement out there among some of the world's best analysts, and that's what makes the market, right? You got to have buyers, you got to have sellers, and I was almost going to leave it there, but I forgot about gold. Look at gold, just continuing to just kill it against a really bearish looking chart. Now, this is a buy signal, but we still have just massive bearish divergences here. Going to get into overbought territory pretty soon if this keeps up. Gold could be reacting to weak economic data, fear over tariffs, fear over this deadline that's coming up here in a little over a week, and that's when those Liberation Day tariffs come back on, August 1st, if there aren't any big trade deals in the meantime. So if we got a lot of good news on that front, I think gold could roll over really hard, and that's why we're hedging our position right here. Folks, I'm going to leave it there, and again, probably be about a week before you get anything from me. I might, throw a quote of the day or something up there in the next day or two. I still have to score our index before next Monday, but I'll do that late on Sunday. So probably won't send you anything until maybe this time next week. Hope you have a good one. Thank you as always for watching and listening. Talk to you soon. Bye-bye.